This is part 3 of my guide to invoice finance, which is also known as receivables finance. You'll find links to the other parts of this guide in the description below. Okay, in this section I wanted to cover the different types of receivables finance that you can come across. The first distinction to draw is to just talk briefly about what's known as construction finance. Now, this is specifically for the construction sector. A lot of businesses in construction don't raise invoices as such. They raise what's known as applications for payment, and that can be a difficulty for a lot of invoice finance companies. However, there are specialists that deal with that. So that's the first product, construction finance, which will provide funding against either invoices or applications for payment. Okay, so if you take invoice finance and break it down, there are two broad product categories. The first is what we call factoring, the second is what we call invoice discounting. Now, with invoice discounting, you are getting a prepayment against your invoices. So when you raise your invoice, you don't have to wait for it to be paid. You get a significant percentage of its value immediately up front, and you can use that for any purpose. With factoring, you get the prepayment against your invoice, but you also get a credit control service. So that means that the factoring company will be undertaking the collection of your invoices for you. Now, this means sending out statements, letters, and also contacting customers if necessary. The quality of that service will vary dramatically between different providers, but if you choose the right provider, it can mean that you don't need to employ any staff to undertake credit control, and also, perhaps importantly to small businesses, you don't have to do that work yourselves. So the next segmentation between products is what we call recourse and non-recourse. Now, non-recourse means that you have the added value of bad debt protection. This means that if one of your customers becomes insolvent, you don't absorb that loss. The invoice finance company will. Now, this can be very helpful, particularly in the current situation where lots of businesses are struggling and having trading problems. It protects you, so you will get a credit limit set by the invoice finance company, and providing you stick within that credit limit for a particular customer, you know that you're safe, that your invoices are covered. Okay? The opposite type of facility is known as recourse. Now, recourse means that you just don't have that bad debt protection element. Now, that can be an option that some businesses will prefer, because they may have a well-spread ledger with lots of customers, or they may have very, very strong customers, and so they're not worried about the potential for bad debts. Okay, the next product split is between what we call selective facilities and whole turnover, also known as full turnover facilities. Now, with a full turnover facility, it means that you're putting all of your invoices through the invoice finance facility. Now, this can be great to generate as much money as you possibly can. So if you need the maximum boost of cash flow possible, a whole turnover facility is the way to go. In other instances, people just want to get funding against one or two invoices. Now, this is what we call selective. A selective facility works such that you can pick and choose which invoices you want to get funding against, submit them to the invoice finance company, and receive a prepayment. The next segmentation within products is the difference between what we call confidential and disclosed facilities. Now, a confidential facility means that there are no obvious signs to your customers that you are using any form of invoice finance. Confidential invoice discounting is a good example of this. So, your invoices don't bear any assignment clauses. There aren't letters being sent from the funder out to your customers. They're not aware of the funder's involvement. You carry on doing your own credit control, and the customers are unaware that there's a funder involved. With a disclosed facility, that's for people that aren't so worried about that. The customers will be aware that there's an invoice finance company involved, but most companies that we deal with don't have any problem with that being the case. The last category of products, which I just wanted to briefly touch on, is what we call all the additional services. Now, additional services could be all manner of different bolt-ons that you can add to a facility. One example might be payroll management. A lot of invoice finance companies are able to also manage your payroll for you, so they will do all the paperwork and run that side for you, which can take a big burden off of your company. Another option could be trade finance, which allows you to pay for overseas supplies or even supplies from the UK. It can grant you an even longer period of credit if you add that to an invoice finance facility. There are various other options as well, but in total there's a facility to suit just about any business, and if you're having trouble finding what you need, please get in touch and we'll do our best to help you out and find you exactly the facility that's going to be right for your company.